makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Jumana Bersachi in Dubai, in for Francine Lacqua for the last time this week. Now, U.S. stock futures sliding after the S&P 500's record streak, with investors awaiting the Fed's favored price gauge for signals on the path of interest rates, which is due out later today. It's forecast to reveal that U.S. inflation quickened in July, and it comes as the Fed Governor Christopher Waller, who's in the running to replace the Chair Jay Powell, once again called for a rate cut next month.
Based on what I know today, I would support a 25 basis point cut at the committee's meeting on September 16th and 17th. While there are signs of a weakening labor market, I worry that conditions could deteriorate further and quite rapidly. And I think it is important that the FOMC not wait until such a deterioration is underway and risk falling behind the curve in setting appropriate monetary policy.
We're joined now by Karim, the head of EMEA investment strategy at BlackRock. Karim, good to see you. You know, when Christopher Waller speaks now, the market pays a lot more attention, mainly because he's the front runner, one of the front runners to be replacing and succeeding the Fed Chair Jerome Powell next year. So when he speaks, it is relevant. To what extent do you think this dovish repricing of interest rate expectations is fueling the risk-on environment that we're seeing in the U.S. right now?
Thanks for having me, Jumana. I mean, when we look at the PCE release that's coming out later today, like you highlighted, I think this will be really important as we still don't know the full impact of the tariffs on inflation. The picture has been somewhat of a mixed bag when we look at the CPI releases behind us and now the PCE. There's some pass-through, but we think we need to wait a little bit longer for later parts of this year to start to see the fuller impact of trade and tariffs. And the point here that I'm trying to make is that as we get a bit more sticky inflation into end of this year and next year, we might see a bit of a pushback on the dovish market pricing for the Fed through to end of 2026. So we think, you know, the two cuts priced for this year look appropriate, but next year look a bit too dovish.
Okay, that's interesting, because the market is pricing in a terminal rate of around 3%, say, by the end of 2026. Does that not tally up with your house view?
I think that's where the inflation volatility piece comes into play and where we might see some pushback in market pricing as we get some of those inflation readings and potential stickiness. So we're looking at you know, two more cuts this year, but next year feels a bit excessive.
On the fixed income side of things, what investors seem to have been doing the last couple of weeks is positioning for a more aggressive rate cutting cycle, as we were just talking about, but at the same time staying clear of the long end because of concerns about policy uncertainty, inflation expectations, fiscal premium, whatever you want to call it, which means the curve has been steepening. What is your view on the steepener trade in the U.S. right now, and can it continue to have legs?
Absolutely. I mean, we double down on that conviction. We share that conviction around the yield curve steepening view in the U.S., very much driven by the back end, as you say. So the back end could come under more pressure, you know, to back up over the coming months and year, because we have fiscal concerns, we have supply concerns, and also when we look at the broader flow picture, we are seeing a bit of a pullback of buying of long-term treasuries from international investors, which we see in the flow data, in ETF and other flow data, which all points to further steepening.
Yeah. One of the big events of the week was NVIDIA earnings. We spent all day analyzing these results. Net, many analysts have actually come out and raised their price targets for the stock. But let me just bring it back to broader equities as a whole, because you know, NVIDIA single-handedly constitutes about 7-8% of the S&P. Do you think from this point onwards we could actually start to see a broadening out of the rally, or is it going to stay specific to that handful of mega cap tech stocks that are driving the performance?
This is such an important question, and one that we're really focusing on in our year-end investment direction. So as we look to the last few months of the year, this final run of the year, and we're positioning for more of an unconstrained approach to investing in U.S. equities for precisely this reason, that we think that there's more dispersion to come in the equity market. We stay risk-on, we're overweight U.S. equities, but we think there's more dispersion to play. Some of this looks sectoral, so we still like the tech sector. The earnings numbers remain strong, but also looking at healthcare, looking at financials. So there's a bit more names in town.
What about the opportunity set in Europe versus U.S.? A couple of months ago, say, back April, May, there was a big drive, diversification drive out of the U.S., people looking at opportunities in European markets because of the valuation, because of hopes around fiscal spending. Do you still see that opportunity set right now in the relative play between Europe and the U.S.?
Yeah, and we were tracking this, what we called the repatriation trade. So this theme where European investors were buying European equities. And it has had a bit of a stop and start in the summer. So saw some pullback in July and August. Flows started to come back into Europe. Some pullback in July with buying more of US. But generally speaking, I would say this theme remains intact. Now, when we look at investing in European equities, selectivity is the name of the game here again, because at a broad level, until we see a big improvement in return on equity in Europe, we don't see the beta play coming through. It's more of an active theme for European equities.
And yet, if you were positioned, say, in European banks this year, you would have made 40% in aggregate on those positions. If you were positioned in European defense, you'd be up 70, 80%, depending on what you have in your basket. Is it not time to trim some of those positions if you've had such a strong run already?
And you hit the nail on its head. So this is the dispersion theme. So the biggest dispersion we've seen in Europe, and you spoke about banks and defense, is this dispersion between international and domestic stocks. So we've had 40% plus dispersion between the domestics, which include stocks like defense industrials, and the international. And part of this is the euro strength, which hurt the earnings of the international. We think this theme does have a bit more to run, because this domestic theme in Europe is not over.
Karim, thank you so much. Great to have you on the show today. Karim Chedid, head of EMEA investment strategy at BlackRock. Well, Fed Governor Lisa Cook's lawyers are suggesting a clerical error may be behind the mortgage dispute, which has seen President Trump attempt to oust her. She warns the move could cause irreparable economic harm. Bloomberg's Rosalind Matheson is with us. So quite clearly, this is a matter for the courts now. What exactly are Lisa Cook's lawyers saying?
Well, what we're hearing now is, in fact, an acknowledgement that maybe there were dual mortgages taken out on primary residences. But if so, there was no ill intent. This was simply a clerical error. Something went wrong in the paperwork. Something was overlooked. But it wasn't done with ill intent. It wasn't done deliberately. And particularly, it wasn't done potentially to profit, because, of course, there can be advantageous financial terms on these kinds of mortgages, in the sense that if this happened, it was simply a slip, that it was not intended to happen. And that goes to the question, really, for Donald Trump of for cause, of firing someone for cause. Like, if someone makes simply a mistake like this, is that enough to warrant their dismissal, especially on mortgages that were taken out before you came into your role at the Fed? You can see that's potentially the legal argument that's going to come from her lawyers, as to say, while she's fighting her dismissal. But what we're going to get today is that initial hearing about an urgent injunction, which would keep her in place while the legal proceedings play out. And that could take quite some time and go potentially through more than one court. But you can see essentially the argument being laid out now is, if something did happen, it was not ill-intended, it wasn't intended to profit, and therefore it doesn't justify the actions which have been taken against her.
Yeah, and obviously, her very seat itself becomes disputed with this protracted legal case. Very clearly unprecedented times, with President Trump being so vocal about various personnel at the Fed, including the Fed chair himself. What does this all mean? What are the implications of this meddling on potentially the U.S. economy and also the credibility of the Fed as an institution.
Well, that's right. I mean, there are massive potential ramifications from all of this, and they could be very long-lasting. Some could be brief and some could be very extended. I mean, right now, you're not seeing markets really freak out over this. They're relatively calm. Some would say too calm, given there's been this decades of understanding between markets and policymakers that you leave the Fed alone, because if you don't interfere, they can make their decisions purely based on the state of the economy before them in the best interest of the economy. And so markets are relatively calm about that for now. But maybe they think that Donald Trump is so changeable that he will change his mind again on the Fed, although he does seem quite set on reshaping the Fed in a way that he feels might be more conducive for his views about where he wants interest rates to be, and that's obviously lower. And does he continue to pressure the Fed to do so? Does he try and get more of his own appointees onto the Fed?
Yeah.
And those appointees then would be on the Fed for years. So could we see a longer term trajectory here? But you are seeing potentially fundamental questions about the future of the Fed and its ability to set policy.
Yeah, not that dissimilar to stacking the courts as well with the Supreme Court. Bloomberg's Rosalind Matheson. Also, for any viewers watching, the full article is up. Our big take today, Trump's attacks risk wrecking the Fed's hard-won credibility. That is up on your screens right now if you want to read the full article. All right, Chinese President Xi Jinping's closest international allies, including the leaders of Russia and India, will be gathering this weekend for China's biggest diplomatic event of the year. The Shanghai Cooperation Organization Leaders Summit will be followed next week by a military parade in Beijing with guests including Vladimir Putin and North Korean leader Kim Jong-Un. Bloomberg senior executive editor John Liu joins us from the Chinese capital. John, good to have you with us. It's quite the guest list for the summit this weekend. I also noticed the Iranian president, Pezeshkian, is going to be there as well. What are we expecting out of this summit?
Well, I think we should expect to see lots of smiling faces, lots of handshakes, lots of effort to show that these are nations, these are heads of state that are here to support one another, that these are friends. I think we will also hear lots of talk about the right of developing countries, the global south, to choose their own economic models, to choose their own forms of government. You will hear they have the right to buy energy from who they want. And I think you will hear a lot of bristling and complaining about American tariffs, American sanctions, American projections of military power. And you will hear lots of talk about how everyone at this meeting is on the same page. And while many of them have very similar interests, I think it's also important to note that some of these countries have very important differences as well. So, for example, India and Pakistan will both be at the SCO summit this weekend, and they are, very, very long rivals. Even India and China, where you see this warming of the relationship, that is really just an attempt to move the relationship from outright confrontation to normalcy.
Yeah, I noted that it was a RIC summit, not a BRIC summit, because you've got Russia, India, China, but no Brazil there. What do you think the messaging is going to be from those three countries in particular to President Trump?
Well, I think, Mr. Putin has a very clear interest. These are his two biggest customers when it comes to energy, China and India, and he wants to make sure that they will continue to be his customers. They will not back down to American pressure, and they will continue to buy Russian oil and gas and fund Russia's war effort. You also have President Erdogan from Turkey at the SCO. So Turkey is the third biggest buyer of Russian oil. And so that I think will be very important. And I think it'll be important for President Xi and Prime Minister Modi to show that they are standing up, even whatever President Trump is saying, they are making the best decisions for their people and their countries. And I think that will be the message they want projected to the global audience.
Yeah. Well, Bloomberg senior executive editor John Liu in Beijing. And obviously, speaking of energy critical, we're going to be talking more about that in the next segment as U.S. investments in clean energy plunge. We'll explore what that means for the energy transition. That's next. This is Bloomberg. Global investment for new renewable energy development reached a record $386 billion during the first half of the year. That is up 10% from the previous year. The data comes from a report by Bloomberg NEF, which also shows committed spending in the U.S. has dropped 36% in the same period. Meanwhile, Goldman Sachs is forecasting a $620 billion reduction in U.S. government spending on green energy by the end of 2032. We're joined now by Michele Della Vigna, head of EMEA Natural Resources Research at Goldman Sachs. Good to have you with us. Some really big themes to discuss here. Maybe let's just start with some of the takeaways from that report. And maybe my first question should be about how the change in the U.S. administration, Trump administration's approach to clean energy initiatives is affecting the landscape for renewables. And one of the big stories, of course, over the last couple of days has been Trump also looking to close some of those offshore wind farms. So how is this all reverberating in the renewables landscape?
I think the US energy revolution continues at full pace. On one side, there's no doubt that hydrocarbon demand keeps growing, especially for natural gas, which is a big winner in the US. But I also think we shouldn't underestimate the renewable growth. That effectively the incentives have been extended all the way to 2030. So solar will continue to grow. Onshore wind will continue to grow. Batteries for grid investment will continue to grow. The only exception is offshore wind, which, to be fair, is so high on the cost curve of the US power generation that it probably makes economic sense for the moment to set it aside. But the revolution in renewables in the US continues, and so does shale. And that is what I think remains one of the key competitive advantages of the US economy.
Well, one of the arguments that I've heard against that is that it's difficult to keep scaling and building up businesses without the right incentives in place. And if your business model is solely reliant on having those credits or those incentives, then the second that they're removed, it becomes non-viable. What's your response to that?
I think that's a very fair comment, but the solar incentives have been extended for every project that starts production in the next year and comes on stream by 2030. So I actually think we have the visibility over pretty much 5 years for these investments. And after that, if the cost improvement continues in solar, many of these projects may be economic even without the incentives. The key is to have the demand, and the demand is there, driven by AI and by industrial growth and reshoring of industry in the US. And I think together with gas to guarantee the seasonality and intermittency and also industrial scale storage, I think actually the US power system is going to be one of the most exciting investment opportunity in the coming decade.
Okay, let's talk about energy demand. The other big, I would say, market event this week was NVIDIA results. And one of the really interesting things that came from the earnings call was the CEO talking about trillions of dollars of AI infrastructure spend over the next decade. How is that going to translate to future energy demand? And where are those incremental sources of energy going to come from to power up all these data centers?
Mm-hmm. Good question. We've got US demand that for a decade was flat. That is going back to a growth of about 2% per annum, out of which between 1/3 and half will be driven by data centers and artificial intelligence. This is an extraordinary change. Where does this new power come from? Clearly, it will come from renewables, mostly solar, but that's intermittent. Then it will need to be balanced with more investment in the grid, digitalization of the grid. It will need to come with storage, so grid-scale batteries, with more gas-fired power generation. And we go back to the structural gas growth story we are going to see pretty much for the next 2-3 decades. And finally, nuclear. There will be a big revival of nuclear. Nuclear is a key technology that can guarantee and underpin this demand growth with grid reliability.
That was going to be my next question. I wanted to ask you about nuclear because I feel like there has been a bit of a resurgence of interest. And I'm here in Dubai, and I know that in the UAE they're investing a lot in nuclear infrastructure to help power some of those data centers. But do you think these nuclear facilities can be built up in time? It takes a lot of time, and they're very expensive, very costly to get up and running.
It will not be built up in time. So it will take about a decade for the new nuclear plants to really be up and running in large scale. That's why, in the meantime, gas and solar, and to be fair, a longer life for coal will be absolutely necessary to fuel the growth. But longer term, to start to invest in nuclear now is absolutely key. And there's also a new emerging technology that is starting to get good funding, which is fusion, which again will not be ready before 2030, but could become an important part of the solution as we start to look at the next decade. In energy, you always need to plan early. Yes, we need a solution for the next 5 years, but we also need to think about the power mix in the 2030s. And nuclear for sure, and fusion most likely will be an important part of it. As the UAE shows, that is always one of the most advanced countries in terms of thinking about the energy system.
Yeah, I'm sure they would love to hear that. Let me just round up by asking about, obviously, the hydrocarbon percentage of the overall power mix. It's something like 80% still today. How do you see that evolving over the next decade?
The percentage of hydrocarbons will start to decline because, without any doubt, solar especially will take market share, and longer term, I think nuclear may also gain market share, but it will remain a very important part of the mix, and in absolute, it will grow. So we see a growing role, especially for natural gas, and although we see coal retirements, we think the coal retirements are going to be much slower than anything we have witnessed over the last 5 years.
Yeah, so interesting. Well, perhaps a point of optimism, especially your outlook vis-a-vis the renewables opportunity set still in the U.S. Michele Della Vigna, head of EMEA Natural Resources Research from Goldman Sachs, thank you so much for joining us. And let's just do a quick recap of how some of these European markets are faring today. We are slipping a little bit in trading. As you can see, Stock 600 down about 0.5%. The DAX also down 0.5%. Keeping a close eye on the inflation data as it comes due. We've already had Spain and France, which have surprised to the downside, and some of the regional numbers from Germany are pouring through. Keep an eye out on that 1 p.m. CPI print for Germany as a whole. Speaking of Germany, coming up, German Chancellor Friedrich Merz says a meeting between Zelenskiy and Putin is unlikely to materialize. More next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai, and these are your top stories. Stocks slip after another Wall Street record as traders count down to today's key U.S. inflation data. Fed Governor Chris Waller restates his call for lower interest rates. Lisa Cook sues to block President Trump's attempts to fire her from the Fed. Her lawyers say the alleged mortgage fraud was an unintentional clerical error. And here in Europe, French and Spanish inflation undershoot estimates, but data suggests euro area price growth will not deviate much from the ECB's 2% target. And German Chancellor Friedrich Merz says a meeting between Ukrainian President Volodymyr Zelenskiy and Russia's Vladimir Putin is unlikely to materialize, despite it being touted by the U.S. President Donald Trump. Now, the White House had previously said Putin agreed to a meeting, but the Kremlin never confirmed their commitments. Joining me now is Bloomberg's Greg Sullivan. So what do we read into Merz's comments? How likely is it really that Putin and Zelensky meet?
Well, on one hand, these comments are not really that surprising. We know that Ukrainian President Volodymyr Zelensky has called for a meeting with his Russian counterpart to try to work out a peace agreement. We also know that President Trump has backed that idea and called for it as well. But so far, Putin has largely just ignored those calls. The Kremlin has shown little interest or little intent to actually meet with Zelensky. We've heard from this Foreign Secretary, Sergei Lavrov, that such a meeting would take a lot of planning and agenda, and there should be agreements at hand. And so far, none of that is ready. So it's pretty clear that Putin does not want this meeting and would probably delay it if it looked likely. We heard from President Trump earlier, who said that it was Putin's personal dislike of Zelensky that was probably holding this meeting up. So again, these comments are not really that surprising. Now, Trump has warned that if the fighting continues with or without a meeting, he would wage an economic war and there would be serious consequences for Russia. But so far, that doesn't even look likely to happen, as Russia launched a major drone and missile barrage against Kyiv, very deadly. So.
Yeah. Overnight, one of the most deadly this year. But let's also talk about perhaps some progress on the Ukraine-U.S. side of things. Zelenskyy's chief of staff is set to meet the U.S. envoy Steve Witkoff in New York today. So what will be some of the talking points there?
That's right. Zelenskyy's chief of staff is one of Ukraine's chief negotiators. He will be in the U.S. Again, one of the major topics of discussion will likely be security guarantees. If the war does come to an end, what kind of security architecture will be in place to make sure that it doesn't restart down the road? Ukraine has been pretty adamant that security guarantees have to be at the center of any kind of negotiated peace. So that's likely to be on the agenda, as well as continued support or what comes next in the war. Or the Ukrainians will be looking to try to maintain any kind of level of U.S. support in their fight against Russia. We're also likely to see the Ukrainians push for sanctions. Zelenskiy has frequently called for sanctions. Trump has been reluctant to impose them and so far hasn't. Again, this meeting is coming in the wake of that Putin-Trump summit in Alaska. So the Ukrainians will be keen to keep Trump at least open to their positions and potentially supportive of them.
Bloomberg's Greg Sullivan, thanks for the setup. I'm going to continue the conversation. Joining me now is Elisabeth Braw, Senior Fellow at the Atlantic Council. Elisabeth, throughout the course of this week, we've spoken to several analysts, their impressions of the Alaska summit and then Zelenskyy's visit to the White House and what came out of that. And I will say that most people are pretty pessimistic that this summit is actually going to lead to any progress on peace talks or a potential ceasefire. Do you share that view?
So what needs to happen first is for President Putin and President Zelenskiy to meet. Without such a meeting with some sort of outcome, any other talk is really, any other conversations, discussion, negotiations are really almost futile, because without Russia deciding that it's going to stop fighting in Ukraine, and without Ukraine agreeing to whatever terms may be proposed and negotiating with Russia to come to a conclusion, without that, nothing else really matters. So Western countries, Western allies of Ukraine can help try to speed that process along. But if Putin says no, then we continue seeing this war in Ukraine and increasingly deadly, as we've seen in recent days.
Yeah. So the attacks on Kyiv are continuing. Let me just ask you about the European response to all of this, because I guess one of the more positive developments has been that European nations, alongside the UK, with the Prime Minister Keir Starmer, have been showing a somewhat unified front. The EU leaders traveled with Zelensky to the White House a couple of weeks ago in a show of support for him. Can this unity hold up, do you think, amongst European countries?
It is extraordinary to see this unit. It has held up now for 3.5 years, more than 3.5 years of war in Ukraine, and under very difficult circumstances, European countries have had to make very painful adjustments. They have willingly given enormous military amounts of military equipment, enormous amounts of financial support to Ukraine, and also received a considerable number of Ukrainian refugees. And even so, their unity has held up. I think that's something it's worth noting now that they meet again to try to figure out what else they can do. And that unity is not to be taken for granted. Let's hope it holds up. But the European leaders so far have done well.
Yeah, I bring it up in the context of the very famous and outspoken these days, Mario Draghi. He gave a speech a week ago where he warned that Europe is merely a spectator at risk of irrelevance. And he's saying that 2025 could be remembered as the year of Europe's illusion of importance being evaporated because of the diminished geopolitical clout that they have on a range of issues, not just Ukraine. Do you think that criticism is valid from Draghi's perspective?
It is valid in the world in which we now live. The world has changed dramatically. If you look at the world 3-4 years ago, the it was set up to function according to various rules, and European countries were key observers of those rules, and under those rules they were also quite powerful, because if everybody follows the rules, then you don't need to be the world's most powerful country to be successful or to have a say. The world has changed since then immeasurably, and that's why they look weak, because they are set up for a world that seems to be deteriorating or vanishing almost on a daily basis.
Yeah. What about the EU-US trade deal? At the time, it felt like a major breakthrough, but of course, von der Leyen went back, and the deal itself received so much criticism from leaders around the continent. What is that going to do to this homogeneity that they're looking for, especially when it comes to these transatlantic relations? Because each one of these countries has different economic imperatives of what they're trying to achieve.
Each one of these countries does have different priorities, and it is amazing, I have to say, that they came together to find a common line, and not just a common line, agreement on details that they could all support in this trade deal with the United States, considering that they all stand to suffer to a different extent from this new arrangement. But they found agreement. They managed to negotiate an agreement amongst themselves that Ursula von der Leyen could then take to Washington and negotiate on that basis. I think what we're seeing is a clash between those trade tensions between the United States and the European Union on one hand, and then the security policy aspect, the defense aspect on the other hand, where European countries, including the EU, try to be as supportive as they can of the United States, because it is a key ally, at least formally and hopefully also in practice, but they are worried that practice may look different, so they have tried to be as supportive as they can, even as these trade tensions linger and cause acrimony at home.
How are you thinking about the French political stalemate at the moment? We know that a confidence vote is coming up. The current government is likely to once again get dissolved. Maybe we're back to the status quo of having to reappoint another prime minister. But of course, this is one of Europe's largest economies. With all of that going on, does it not hold back the rest of the European bloc? Because France and French leadership will be so focused on domestic political matters that it will be difficult to focus on more broader European ambitions.
It is interesting and extraordinary to see France when I think those of us who were alive maybe a few years ago, most of us will remember the constant turbulence in Italy. Now Italy looks stable. It has governments that stay in power for a few years and get things done. In France, that's not so much the case. And it is fascinating to watch today, this very day, the governments of France and Germany are meeting, ministers from France and Germany are meeting. The Germans are meeting with their French colleagues, knowing that in a few days' time they may no longer be in office. They will most likely not be in office. It is a bit of a concern to the rest of Europe, or to the strength of Europe, because the EU and the wider Europe need France to be strong, need France to be able to articulate policies, and that's hard when you don't have a stable government.
Yeah. Elisabeth Braw, thank you so much for joining us on the show today, Senior Fellow at the Atlantic Council. Well, speaking of France, as we were just talking about, it's grappling with political turmoil as Prime Minister François Bayrou faces a make-or-break confidence vote next month. He's set to negotiate directly with lawmakers next week. Now, earlier this week, the so-called French risk gauge hit a 7-month high, with France's benchmark bond yield premium over Germany topping 80 basis points. Now, Bloomberg's Julien Pontus is in Paris. We're looking at markets and sort of tracking all these market indicators to get a feel for how investors are thinking about the confidence vote. Some stabilization coming through in the last 24 hours, but does that necessarily bode well for Bayrou's chances at this confidence vote?
In a nutshell, absolutely not. I think what the market has priced is that he will fail. and he will be toppled on September the 8th, and that's the market pricing that you have. And it's actually not that dramatic when you look at it. We're back at 80, as you said, basis point, which was more or less the level of the political crisis when you get a little spike. The French stock market was hit like 3% on the first 2 days. Now it's stabilizing again. Some people, are looking to buy the dip. Some people are thinking, if he appoints another prime minister, if the budget can be rolled over into 2026, there are some scenarios where everybody lives. There are other scenarios, though, after the vote where you could have snap elections. You could have even some people are talking about Macron resigning. Obviously, it's not what people expect, but it's a possibility you can't rule out at 100%. But I would say people have priced, markets have priced the current, the level of political risk that there is, and it's still at a moderate level. I mean, there's a lot of room for things to get worse.
Yeah, okay, well, that's not a greatly positive note to leave it on. Just in terms of the near term, though, in the run-up to that confidence vote, are we expecting more turbulence, or is the outcome already priced in, do you think, over the next week, and that they probably will fail, and at that point, then it becomes a matter of whether elections are held or whether they can appoint a new prime minister?
Yeah, as I said, I think markets are pricing Beirut to fail. If you look at betting websites, it's over 90%, 95%. When you look at the seats at the National Assembly, it's really hard to see any way for him to pull this off. So I think markets are pricing that at the moment. And probably they're hoping that Macron will appoint a new center-right, center-left PM, and that this will continue. I would expect probably some more turbulence if snap elections are announced after the vote.
Yeah. Okay. Well, we're going to keep a close eye on that risk gauge, as we've called it, the difference between the 10-year French yield and German bond yield. We got up to 80 basis points. We've now recuperated some of it, but still back at the highs not seen since earlier this year. Well, moving to the UK now, a think tank says the UK could raise more than £32 billion over 5 years by imposing a windfall tax on commercial lenders. The proposal from the left-leaning Institute for Public Policy Research says the government should recover the profits banks are making from taxpayers on deposits held at the Bank of England. It says high street lenders have enjoyed a, quote, staggering state subsidy on the Bank of England's QE program in recent years. So this is a look at some of the key UK banks this morning. Really adverse reaction to this news that has come out. And of course, I should just say this is a think tank proposal. We have to wait and see what is unveiled at the autumn budget. But still, adverse reaction. You've got Barclays down 3%, NatWest down more than 4.4%. Now, sticking to the UK, lobbyists are lining up to attend Reform UK's annual conference next week. According to data obtained exclusively by Bloomberg, 20% of public affairs executives are planning to head to the Populist Party's event. It is a sign that corporate Britain is increasingly taking Nigel Farage and the Reform UK party seriously as an electoral force. Bloomberg's James Woolcock has more. James, I've got to say it's an amazing evolution for the Reform Party since its inception, put together as sort of a fringe group. And now you see it becoming more and more mainstream, racing ahead in the polls. What does our own research say about lobbyists' inclination to participate in this conference next week? And why are they doing it?
So 2 years ago, 4% of the people we surveyed who are public and lobbying executives, who are the kind of people who are influencing businesses, working inside finance, healthcare, education, they went to the Reform 2 years ago, 4%. Last year, 12%. This year, in a survey that we've exclusively obtained alongside Opinium and the Chartered Institute for Public Relations, that's now 20%. That is pretty much level pegging with the Conservatives and far beyond minor parties like the Lib Dems or the Greens or the Scottish National Party. It suggests that Reform are establishing themselves in the first time in the UK's past 100 years as a third party in the mainstream. Now, I spoke to Opinium's head of public affairs, James Crouch. He told me business are now taking reform seriously.
Reform is doing well in the polls. Organizations want to understand basically what it really thinks, where it's headed, because I think a lot of people would say they don't really know. There's also a lot of scope to kind of influence that direction as well. Far more than a governing parties conference. An opposition parties conference is a great opportunity for organizations to get involved, try and influence the direction of policy and its priorities.
Now, that doesn't mean it's a dead set that reform would be, say, the next government. James told me that actually local elections are still a big factor next year to see if they are serious. But the words used of business are dipping a toe and are curious to see if reform are a party that can be lobbied.
Yeah, well, here's the thing. As it stands, the Reform Party only has 4 MPs in the UK Parliament. Therefore, why such a big interest in trying to work more closely with them and attend the conference next week?
I mean, it speaks to that IPPR report you just mentioned there earlier, Jemana. Business are casting around to see which political parties in the UK are genuinely the party of business. Now, Labour, as the government, has caused a lot of fears in the business community that they have a big fiscal hole to fill this autumn. There are all sorts of think tank proposals around taxes they could raise. Windfall charges on banks are one. Gambling taxes are another that's been raised. Another potential wealth tax. And so, meanwhile, with Reform being the highest polling party in terms of popularity in the UK, that may not hold till the next election, which could be as late as 2029, but certainly it's worth seeing to see what kind of policies a Reform government theoretically could give to business.
Yeah, the polling numbers are really quite staggering. And just to point out, for those not closely watching it, that Reform they're polling ahead of the Labour Party right now. So it's really quite fascinating. Thanks for walking us through it, James, Bloomberg's James Wolcock. Well, coming up, Chinese e-commerce giant Alibaba will report first quarter earnings later today. We'll have the details next. This is Bloomberg. Well, some breaking news just in. Thailand's Constitutional Court removed the Prime Minister, Paetongtarn Shinawatra, for an ethics violation. The second leader has ousted in just over a year, in a move that intensified months of political turmoil. The 9-member court said Paetongtarn violated constitutional provisions on ethical standards in a leak call with former Cambodian leader Hun Sen about a border dispute. Judges said while she wasn't found lacking in integrity, her remarks undermined the pride of premiership and the nation. So just adds to the political instability in Thailand at the moment. Now, U.S. trade provision dating back to the 1930s, which eventually cleared the way for almost 1.4 billion small parcels each year, came to an end at midnight, New York time. The de minimis tariff exemption allowed packages worth up to $800 to enter the U.S. tariff-free. The Congressional Budget Office estimates the move will raise more than $23 billion in additional tariff revenue for the government over the next decade. And Denmark is cutting its forecast for 2025 economic growth by more than half amid weaker prospects for pharmaceutical giant Novo Nordisk. According to government documents seen by Bloomberg, GDP is expected to expand 1.4% this year. That is down from the government estimate in May of 3%. The government cited U.S. tariff increases and a weakened outlook for the pharmaceutical industry as drivers for the revision. Chinese e-commerce giant Alibaba is set to report first quarter earnings later today. It comes after an intense price war in China's food delivery sector, which is hitting the country's e-commerce companies, forcing analysts and investors to slash their share price targets. For more, I'm joined now by Robert Lee, senior analyst for Bloomberg Intelligence. Well, yesterday, was it the day before, we were talking about Meituan and the downward move that was posing to the Hong Kong indices. What is that likely to do in terms of expectations for Alibaba today? This price war rages on.
Yes, exactly right. And I think two things are going to be in focus for the results. One is the margins, for obvious reasons. We've got price war in the mainstream e-commerce sector, and as you just referred to, and for those who don't know it, Meituan is the leading food delivery company in China, extensive market share across the whole, vast nation. And as you can probably appreciate, food delivery, though, is not a particularly high margin business. It's a scale and a volume business. So JD.com and Alibaba have been making strong inroads there, but the question is at what cost? So they've clearly been undercutting the pricing of their main rival, and I think that raises a major question mark on the level of margin that we see from Alibaba. So the other thing as well, there's been a lot of government subsidies. The government has done everything it can to underpin and support consumption within the country, given the economic headwinds and the tariff uncertainty. So again, somebody's ultimately got to pay for those subsidies, and that raises an additional question on margins. And then thirdly, within their AI business or their cloud business that services external AI customers, if you remember last quarter, they actually missed margins on there because like many subsectors within tech in China, the competition is cutthroat. It really is, very, very extreme. So I think there's a third area of margin risk there.
Yeah, and how is it faring so far versus some of those competitors that we have up on the screen right now, the likes of JD.com, Tencent, and others?
Sorry, I'm really sorry. I lost. Can you repeat that question? I seem to have lost.
Of course, I'm just asking you how it's faring versus its competition right now.
In terms of e-commerce, Alibaba's the incumbent, and obviously it needs to defend its position. Taking a step back, though, we've seen a number of strategic changes with Alibaba. If you remember, within the last 2 years, they actually put forward a plan to disaggregate the business and maybe spin various parts of it off to try and realize value in recognition or in response to very strong shareholder pressure to realize more value, because this is a business which has been under sustained pressure for a number of years. They then did a complete about turn on that plan. And they have doubled down on their efforts to both defend their existing market share and make inroads in new markets. But again, that comes through cost cutting with the impact on margins, as I mentioned earlier.
Yeah. Robert, always good to chat to you. It's been a busy week. Robert Lee, Bloomberg Intelligence Senior Analyst. Well, listen to this story. Pop Mart's new mini Labubu dolls have sold out across China after their release across online retail channels in the country yesterday. The toys went on sale at 10 p.m. local time, and all available inventory was gone before some could even load the purchase page fully. The frenzy lends weight to the brand's staying power. Pop Mart's stock is up some 260% this year. So one for the Labubu lovers out there. And I know there are a lot of them over here in Dubai. All right. On Monday, our Brussels newsletter gets a fresh look with Bureau Chief Susan Lynch at the helm. So make sure you sign up for that at Bloomberg.com/newsletters. You do not want to miss. All right. Up next, Bloomberg Brief. This is Bloomberg.